Okay, it's 11 o'clock. I should get going. Hopefully, no technical failures this time. But normal sort of pattern, we're going to run through some news first, and then I'll be talking to Alex Crooke of Bankers Investment Trust. So news that I pulled out this week is there on the screen. We'll start with Blackstone loan financing first. This is a relatively obscure fund, I suppose, but it was quite big, always quite big. And actually, I think it's done a reasonable job. This chart that I pulled out from our system only goes back to 2019, sort of like, yeah. But if you go back to the start, it's actually produced decent returns. Most of them sort of from the income that it produces. It's on a biggish discount, and it has been for a long time, and that was part of the problem. But the yield is enormous, and that's because of the way that it invests. So it's a structured debt fund investing in collateralized loan obligations. So these are parcels of debt that are sort of divvied up into tranches, where the senior tranche is the least risky and gets a low return, and at the bottom there's sort of equity tranches. And this is what this fund was holding. So it was creating these CLOs by packaging debt together, then selling off the interest in all of the junior things, senior things, sorry, and keeping the junior stuff. And as I say, it's got a pretty good track record. And it did grow and grow. There was another fund called Caridor that it absorbed with an issue of C shares, and then that all got merged in. So it was quite big. But the discount started to open up. And in January 22, the board started to talk about what should we do with this thing. And initially it was saying we're going to have a continuation vote in 2024. But then by the time we get through to June 23, it said, well, we're going to just wind the thing up. The discount's more than 30%. We can't grow it anymore. Because of the way these things are structured, and they will have a sort of a life, and it's quite hard to break them. We're just going to sit there and let them run off, and that will take about 7 years. And they started handing money back earlier on this year. And then they announced another chunky return of capital just a few days ago, the 61 million euro one. But today they said we've agreed to sell the holding vehicle that holds the portfolio, so all of the underlying CLOs, to an affiliate of the manager. So this is a related party transaction. So that means it all needs to have shareholder approval for about 304 million euros. Because they want this to be completely above board, none of the kind of connected shareholders are going to vote on this. But the independent shareholders holding 28% of the company have already said, yes, we will vote for this. So I think it's quite likely to go through. The good news is, obviously, instead of taking 7 years, and there was a big chunk of money they're saying will be on come out until 2029, you'll get everything now up front. In terms of the amount you're getting, it's a premium to the last closing price, which is obviously ticking the box. But it's a discount to the underlying NAV. And there are two different NAVs here. So one is a theoretical NAV and where they think the prices should be, and the other one is based on where the prices are. And it's just slightly tighter. I think if you look at that 4.3% mark to market discount, really, this isn't a bad deal. I'm not a massive fan of selling things off cheaply, and you know that I moaned about holding property income, and they sold that on the cheap to get the thing done quickly. But I think here this sort of makes sense. So the plan is they're just going to sell everything off, distribute the proceeds, and then delist it with the sort of little run things to tidy up, and then go into liquidation. So I think this is probably good news. And worldwide, we know that this has been pretty dreadful in terms of what's happened to the NAV since rates started to go up and growth stocks derated, and it lost an awful lot of value. And it's been sort of going sideways for a while now. But you can see there's sort of at the end there a slight tick up. And obviously the discounts come rattling right in. So today the discount's only about less than 5%. And that's obviously good news. But back in the days when it wasn't tight, the board said we need to hold a strategic review, we need to think about what's going wrong here. They've tweaked what's going the way that things managed. So the two deputy managers, Lucas Svetlana, have been promoted to co-managers. So they're now three co-managers alongside Doug Brody. And they just think that's going to be a sort of better sharing of ideas, really. They're trying to make it a slightly high conviction portfolio. So they've reduced the number of stocks in the portfolio to between 60 and 100. They're benchmarking it against the S&P Global Small Cap. They've been doing that for a long time, but this is kind of now being enshrined into the investment objective. But the portfolio will not look anything like the S&P Global Small Cap, and I'll show you in a second where it is now. The other big change is that they used to say small cap is anything less than 5 billion, and we won't buy anything that is more than $5 billion. Now they're going to say it's the market cap of the largest stock in their benchmark index immediately after the index is balance. So basically, everything that's too big gets pushed into the large cap index anyway. And so what you're left with, the last September, the largest stock in the index was $29.5 billion. But currently it's about 44, but that 44 billion market cap stock will probably get promoted. So that's really quite chunky. That takes you quite a long way into the FTSE 100. And I was a bit dubious about this, but I don't think it's going to be a routine thing that they're going to be buying really massive companies. If you look at the mean and the median of the market caps in that index, and there are 11,000 companies in the index, it's more like 1.5 billion for the mean and about 800 and something for the median. So I don't think we're going to see a rapid kind of move up the market cap scale. This is not perfect, but this is their breakdown of where the portfolio is on the fact sheet, and this is the breakdown of where the index is. And you can see there's quite big differences here, and that reflects the skew of Emerald Worldwide towards growth stocks. So it's got nothing in energy, nothing in utilities, that sort of stuff. So it's just reinforcing that message that regardless of what they're doing here, they're not going to be trying to replicate the index, which is obviously a good thing, I think. And then the other thing about this is I've been a bit antsy for a while that SpaceX has become such a massive part of the portfolio. So this is at the end of October. Baillie Gifford are quite good about revaluing things on a regular basis, and that percentage has gone up. I am not sure, though, whether they've fully revalued it to reflect this tender offer that's happening in December. But what I'm kind of hoping, and we're just going to have to wait and see, is that they use this opportunity in December to try and reduce that stake a bit, because I think it's just too large a part of a fund that's supposed to be a small cap fund. And obviously this is a very big company now, even though it's unquoted, it is a very big company. And it's a lot of stock-specific risk as well. So we'll just have to see what happens in December. The other thing that they said in all this was we're going to cancel the share premium account, which creates about a £500 million distributor reserve, which is a good thing to do anyway. It's just good kind of practice, I think. It just gives you the board some flexibility in case you would need to do anything, in terms of returning capital. This needs shareholder approval, but it's quite straightforward. Lots of other funds have done it. And it will carry on with buybacks where it needs to. It's already bought back a fair chunk of shares this year, but it's kind of committed to return £130 million next year. I think that's slightly too aggressive. So basically, if the discount now is 4.7, there doesn't seem to be much point in handing money back. If you want to sell, you can sell in the market. And there are discount-driven shareholders on the register, notably Saba, which has been stalking a whole bunch of different funds. But I kind of feel that if the thing's trading at a fairly tight discount, there's no need for the board to be doing anything to facilitate an exit for it. And so we'll just have to see what happens. But I don't really want to do tenders or anything else unless they really, really need to. So that's that one. And then just very briefly on UK Microcap, we've talked about this. It's tiny now, partly because of the performance, partly because they keep doing these annual redemption opportunity things. The discount has been quite stubborn. That hasn't helped, which just reinforces what I've been saying for a few weeks now about these annual redemption opportunities. They don't work. And this time round in October, they lost 40% of the fund. And so it really is too small now. So they've talked to shareholders about what to do and decided they're just going to wind it up. I think it's a real shame. They are offering you a chance of a rollover into a current open-ended fund, but I don't think that microcap stocks sit very well in open-ended vehicles, to be honest. I just don't think they're liquid enough to do that. I think it's much better to have it in a closed-end structure. And I suggested on when we read the news that there is still River and Mercantile microcap is the last one left. So maybe there was a way of trying to switch into that. But the real sadness, I think, here is that we've had this pressure on the UK stocks for a long time, pressure on the small cap for a long time, and then this pre-budget massive sell-off of AIM. And it feels to me like this is kind of the bottom of the market, and this is not the right time to be selling stocks, but there we go. So that's enough for me. Now we're going to talk to Alex. So good morning.
Hi there, James. Yeah, welcome.
So we've got a presentation for you. I'm going to just let you talk about the fund.
Okay.
And tell us a bit about what Bankers Investment Trust is trying to do, please.
Right. Well, do you want to jump on just one slide and quickly cover some of the headlines, I suppose? So the trust itself, very much sort of income and growth, really. So we've got a twin objective here to grow the capital above the FTSE World, and also to grow the dividend above inflation, UK inflation. So that's sort of a real return on the income line. Now, we're one of the dividend champions here with 56 years of consecutive dividend growth since 1966, and just after City of London, with the second longest record of that consistent dividend growth, yielding about 2.4% today. We're obviously in global stocks, so they yield a little bit less than City of London, but still a decent yield and something that continues to grow. We're forecasting about 5% growth this year. So the trust is very much income and growth, global equities, and we're about $1.5 billion of assets listed here in London, but also actually in New Zealand as well. So we've got some New Zealand investors. We're listed down there. About 13% of the register is from New Zealand. And then I've been manager since 2003. Previous manager, Michael Moore, was manager from 1978 to 2003. So you really had a lot of continuity of investment style and process there. Sort of two managers, nearly 50 years now, and consistently growing NAV on the right-hand side there. So if we jump on a little bit, let's look at a bit more detail, really some of our core principles. So I think that twin objectives really drives a lot of our investment process. So we're looking essentially at companies which grow cash flow and generally pay dividends. We have some stocks that don't pay dividends. Some of obviously the Mag 7, things like Meta and Amazon that we own that don't pay dividends, but are great stocks for compounding that cash flow. And we really hope in the future they will pay dividends, as we're starting to see in things like Meta over in the US. So looking for companies, consistent dividend growth, strong balance sheets. So, quality bias to a lot of companies we own, which again, in very strong growth markets, when everybody wants the new thing, we maybe lag a little bit, but we'll certainly make a lot up when life gets a bit tougher and these quality names sort of come to the fore. So, not necessarily value per se. I've put there a couple of, down towards one. We can shift between value and growth. The US portfolio looks quite growthy, but that's really what you've been having to invest in to get return out of the US market. The value end of the market has really struggled in the US, but value works a bit better in Asia. Also worked a bit better in parts of Europe as well. So, those portfolios look a bit more balanced between both some value names, for instance, financials, but also some growth opportunities we'll touch on in a bit. The portfolio itself, I'll show you the team in a minute, but we're essentially split into regions, covering Japan, Asia, Europe, and the US, and really trying to find 100 stocks. So in that whole region and all those regions, so concentrating towards our best ideas to give ourselves some decent tracking error against benchmarks. Very much believing in local experts, and I'll show you the team in a minute. And then finally, really trying to make sure we do this at a very efficient way and low cost. So we don't have performance fees. We're not paying other managers to run the money. It's all run in-house at Janus Henderson. We're some 2,500 employees. We've got sort of 70 odd analysts covering the globe, and a lot of PMs in both sectors, specialists as well, to draw upon for investment ideas. So we're doing that all with an ongoing charge of 0.5. So that includes all the costs of running the investment trust, and the management fees are about 40 basis points, so 42 basis points. And then finally, we've got some gearing, as a lot of trusts do. I'm sure you've discussed that details at previous calls, but our gearing, about 8%, is roughly maximum gearing at the moment. We're actually towards the lower end of that, about 3% geared today. Definitely taken some profits in the market run-up we've seen in the last few months. But the cost of our debt is now only about 2.7%, and the first expiry is way out in 2035. So we've got good long-term debt at a very low cost as well, which should be beneficial for investors. So jump on one more. Look at the team. I mentioned myself. I've been investing since 1990. First of all in the US market, but then pretty much going global from the mid-90s. And so, a lot of experience running hedge funds, pension funds, and investment trusts since 2003. And then I've got a team here, very experienced managers, all with decades of experience in their markets. But importantly, they invest locally. I think that's really important. So Jeremiah there sits in Denver, which is our head office in central USA. Jamie here, there's running a pan-European, including the UK, in London. Junichi is in Tokyo, and Sat there is in Singapore. So really embedded in their regions. I think that gives them a good grasp of what's working, what's not working, and closer to the companies to meet them as well. So I've mentioned before, dividends matter to us. It's part of our objective. So the fund does need to generate a decent yield, but we do own some zero yielders where we think the growth and the cash flow is definitely inflecting upwards. Very much free cash flow is probably our one metric that unites us all. So let's talk about markets, I suppose, and more the grist of what's going on. Now, I just thought I'd put one slide really to define, I think, how we're thinking forward from here. And really, this is global long bonds, 10-year bonds aggregate around the world. And you can see that's pretty much my career from 1990, long bond yields of 8-9%. And they've just continually, we call it the ice age, as they've just glided down all the way to almost zero, sort of through COVID. And we've had, to my mind, a major reset. You can see that line has gone up. Bond yields are sort of around about 4, a little bit lower in Europe. And obviously Japan starting to raise interest rates and hoping their long bond yields will rise as well. So I feel there's been a big reset in the cost of capital here, and we're still only just beginning to see the effects of this. And so the next 5 years, if we look out on our investment horizon, I think we've got to factor this in. I don't see this going back towards zero. I think inflation, being that sort of genie in the bottle, has been let out, and it's very difficult to get back in again. We're seeing persistent wage growth, deglobalization, as well as increasing costs. So a lot of factors out there, I think, are leading to, inflation should be in this sort of 2% plus range rather than below 2% when we had those very low interest rates. So, I think we've got to factor this in, this cost of capital. It means a lot of areas in finance where cheap debt was funding a lot of ideas is really historic. And as those bonds roll over and reprice, we'll see a resetting in valuations. And we're seeing it in a lot of the corporate world as well. A lot of corporates are quite clever and termed out their debt. But that's, the consequences of that are slowly tightening on a lot of industries that are over leveraged. So we're trying to factor that into what we're doing within the portfolio. And we're finding a lot of interesting ideas that should lead out of that. I've got a couple of areas, though, I'll focus on to give you a bit of a flavour of where we're quite excited currently. So if we jump on a slide, I think as a theme, electrification is going to be an increasingly powerful theme for us. It's actually tricky to get, really interesting ideas in here. A lot of this story really is running through, I suppose, the electric cars. It's running through data centers. So our requirements in the economies and growing developed economies is going to need a lot more electricity than we're used to. If you look at the graph showing you their US power demand, it's been pretty flat for the last couple of decades. And within there is a growing demand for electricity, but countering that is a increasing efficiency, moving to LEDs and et cetera, et cetera. So pretty flat demand over the last few decades, but the next 2 or 3 decades we look forward, massive increase. Trump, I think, will slow that towards electric cars, but I think the future is pretty clear over a couple of decades. And then obviously data centers, huge new increase in demand for electricity coming in there as well. And so we're seeing, this theme happening everywhere. If we look at some of our bigger holdings on the right, Nari Technology is a Chinese company. This is happening quicker, much quicker in China. This push towards EVs, the price points of EVs really driving very rapidly, I think, from gasoline engines towards electric, and really trying to improve connecting renewables as well. So Nari is right in the middle of all that, of trying to develop technologies to extend the grid. Power Grid is in India. So again, a nice emerging market story again there, driving electrification through the economy. And then we've got companies that make a lot of the equipment which goes into these countries. So Siemens and Hitachi. Hitachi's been fantastic stock for us over the last 12 months. Train Technologies, again, a lot about air conditioning for data centers, but again, more data center story than Honeywell as well. So this is about 5% of the portfolio, and it's growing. We're looking for new names. Some of them are a bit expensive, but I can see this growing towards 5 to 10% over the next year or so. And that looks pretty much a very nice theme, electrification. The next one is about healthcare. And I think, first of all, two of our biggest holdings are Eli Lilly and Novo Nordisk in Europe. And so these two companies really are the forefront of what we call GLP-1. So these are the anti-obesity drugs and diabetes control drugs. And I think, both diabetes and obesity are the two really biggest healthcare issues, I think, for developed markets and developing markets. And so we're just on the left. You look at the scale here, it's in billions. These are the forecast revenues growth for these GLP-1 drugs. We're right at the bottom there, about 10 billion of revenue currently. And this is forecast in the next 5 years to grow to 80. So huge growth. They're spending a lot of money putting in production here. It's just launched. Wegovy is just launched in China. Again, a huge market, I think, for obesity and both diabetes as well. So we see huge growth coming in here. And really the first two companies, Eli Lilly and Novo, I think will take the majority of the market share in these markets. A number of other companies have got similar drugs, but I really think the dominance of the two names there and the longer term records should mean they're winners. So this is a great advance. And then on the right, really again, healthcare. We've been pretty light healthcare for the last sort of decade, and really essentially some big drugs coming off patent and people replicating those at much lower cost. But I think we're beginning to see, with a bit of AI and a bit of other things, gene mapping, we're seeing actually increasing number of new compounds coming, and in some very interesting areas, which should see very strong growth that we're seeing with these GLP-1 drugs. So we're very excited, I think, about the future here. We've got a very impressive healthcare team at Janus Henderson to help us find ideas in this space. And we're very excited, I think, about the future for healthcare. So it's finally, from being about 2 or 3% of bankers' assets, we're about 10, 11% today and growing. It's cheap. It's been a bit left behind in the rush for AI, but this is a sector that should benefit very materially from AI development in terms of new drug and testing for drugs and compounds. So again, an area I think, down the road of AI is very exciting and a lot better value than some of the key components of the manufacturing of certainly chips in the AI space. So that's sort of healthcare for us on the edge of an age of innovation. If we jump on, finally, a sort of market we're still favoring very much. It's drawn back a little bit in the last 6 months, but I think really to us still very exciting is Japan. And here we're about 13% of the portfolio in Japan. And essentially, I think the story is definitely an economy that's picking up. We're seeing some inflation. Finally, wage growth is picking up as well, which is the driver of inflation. And so we should see consumption improve as well. On the back of that, if you think prices are going up in the future, it draws forward a lot of consumption. Whereas in deflation, then why buy now when you can buy later? So I think we should see better trends of economic growth in the market. But on top of that, it's really what the companies are doing and improving. The cost of, the return on equity, Japanese companies is still about half the rate of the US. So a lot of room to improve return on equity. And we're seeing that come through in some of the aspects on here. So dividend payments definitely improving. You see that green line nicely accelerating up. So payout ratios are rising, but still only about a third, and the US, and Europe about half. Buybacks are improving quite dramatically, which again is showing the value of equity there. And we're also seeing, a lot more, I think, governance improvements as well, where companies are a lot more pressure now to stay in the indices, to pay out cash, reduce cash on the balance sheet. And that's all leading to better leverage for us as equity holders. So we should see equity return continue to go up. So at the bottom there, we've seen over 10 years, got a 7% compounding growth in earnings, but that's led to 9% compounding in dividend and 17% on the compounding on the buyback. So again, I think still a very nice story of the economy getting better, some great companies in certainly industrials and technologies, and increasing better governance leading to better returns. So we jump on one more, look on really positioning. So US, is the largest global region. It's not surprising to see our largest holdings there. And again, focusing on a lot of companies that generally pay very good dividends. So, this year, certainly the winners have been American Express there for us, has been actually our number one contributor to returns in the portfolio. We've got some of the chip manufacturers in there, KLA, Broadcom. Again, we're very excited about Broadcom. It makes sort of ASIC, AI chips that are very focused on speed. And actually, we think that's a very interesting growth story, much better valuation than NVIDIA. So a lot of US names. I've mentioned the Japan exposure, really doing there. We've probably cut back UK and Japan and Europe this year. It's definitely had a tougher period of growth, but is beginning to look more interesting than some of the names there. So we focused down a little bit on those companies. If we jump one more into sectors, you can see, very much information technology is big for us being a global fund. We've narrowed that a little bit this year as obviously the market's focused on some of those Mag 7 names, but we're trying to, as I've mentioned with Broadcom and some other names, sort of dive down a little bit lower for better value, but good growth, definitely getting very expensive valuations for the US market. And financials is something I didn't mention before. And again, I think what's interesting there, we've switched a lot of our holdings from sort of what you think of sort of fee-paying financials, historically, into net interest margin sort of financials. We believed that rates would stay higher for longer, and that's certainly coming through. So a lot of the traditional banks, and Morgan Stanley in the US and UniCredit, Italian Bank have been, again, two of our best performers over the last 12 months. And really that net interest margin improving fees, interest for them has definitely been a big run there. And then also insurance, I mentioned again, resetting of rates. A lot of that cheap money found its way into insurance markets, and that's beginning to ease out. And we're seeing, one element of why insurance rates are rising is definitely that money exiting, and it's leaving the traditional insurers to make a better return, I think, on capital. So again, opportunities are rising in there. A bit lighter in some of the industrial areas, so energy, materials, again, with China struggling to grow, definitely not a place to be in the short term. And then on the right, you can see our sort of allocations. The US is sort of 46%, UK is about 7%, Europe 22%. So in North America, it's a big chunk. It's not as much as the index. But again, I think, it is an expensive market. It's had a very strong run, and we're seeing sort of better opportunities, I think, parts of Asia, definitely in Japan, and bits of Europe as well to compare against it. Finally, I think, always mention the discount. I'll put the long-term chart here, 5 years. So bankers, traditionally trades at a tightish discount. We're actually issuing shares in 2020. So over 5 years, we've still got a positive, net share count, actually. But we've been buying back as all discounts sort of widened in that 21 to 23 period, I think, as interest rates rose. And obviously, certainly a lot of investors decided that 5% risk-free annual rate was better than being exposed to the market. And so the whole sector's moved out, almost all investment trusts really. And we're buying back pretty steadily. And we think it's good value in this area, sort of just over 10% discount. And again, historically, we've had a good support from investors, and I expect that discount to narrow at some point. But we've bought about 6% of shares back this year, so we think they're good value. So with that, I think with my 15 minutes just about up.
Very good. No, thank you very much. You've covered off some questions that have been asked, I think, but where should we go first? I think there's definitely Magnificent Seven. I think that's preoccupying a lot of people's minds. So how many of them do you hold, and which ones do you favour or not favour? Where do you think AI is going?
So we hold 5. It's probably easier to knock the 2 off that we don't hold, and one is Tesla, where it just I'm not sure it's trading a lot of hope and ideas, which may well work, but it doesn't trade on a traditional valuation basis. You've really got to assume that they're self-driving cars, and I suppose that's really the big opportunity is self-driving. Their software is adopted by a lot of other names. I think robots is still a bit too far out, and I think it's just not been a traditional stock for us, given its volatility and its again, the cash flow is a lot of driven by credits, which again can be turned off as well. So I think that one we struggle with. Nvidia, definitely was a miss initially. We don't own that one. It's come from very strongly, but was always very expensive, and so I think it's always one that's just popped out of our trying to avoid expensive stocks. But it's been an amazing run. We've tried to capture that semiconductor run, and we have done in things like Taiwan Semi. We own a lot of that one, which is manufacturing all of Nvidia's chips, and that's been performing very well. My issue with Nvidia, I suppose, is price. It's on a very high multiple of sales, which is an industry that is traditionally cyclical. It has a book. We always value these things on book to bill, i.e., the amount of the orders they've got and the amount they're shipping, and that's because this industry is volatile. It takes, I don't know if people know this, but it takes somewhere in the region of 4 months to make a chip, getting longer now for these really complex GPUs, so 4 to 6 months for those. So you've always got to be manufacturing massively ahead of demand, and that leads to a lot of oversupply at certain points. And so yes, there's a lot of demand at the moment, but I historically don't think you should be paying 60 times earnings, 50 times earnings, and 20 times sales for these sort of industries. And so those are the 2 we don't own. We're very excited by probably Meta. I think is very interesting. If AI is going to work, it seems extremely well placed and is not priced for it. The underlying business is doing very well, and their AI models are very highly regarded, but are really not in the price in our mind. And they've shown over the last year or 2, the ability to turn the margin up very dramatically, which has done very well, as Amazon, which is another one, clear category killer. And again, turning the margin up. We always knew they could reprice at some point when they wanted to stop growing, and they managed to keep the growth and reprice the margin. So those are probably 2 of my favorite picks in the Mag 7. But I think AI is in general, I'd say I'm a little bit more skeptic that the returns on this huge investment are going to come through. I think they will on a 5 or 6 year view. I worry a little bit in the shorter term that the market's going to get more harsh and say, well, where is the revenue coming on this massive increase in capital spending? If we think we're 2 years since ChatGPT launched its product, that they're making a bit of revenue, but really not a lot. And I'm not seeing the killer app or the things that are changing our lives dramatically, neither now or in the next year or 18 months. But AI, as I mentioned, with healthcare, with some efficiency gains and it is helping a lot of companies. And so I think 5-10 year view, without a doubt, it'll be transformative. But I'm struggling to see it as the industrial revolution of the future. So a little bit of skepticism, I think, is probably always healthy.
Yeah, fair enough. Um, so you mentioned Broadcom. You mentioned you say you do hold TSMC, the Taiwan
Yep.
Semiconductor. Do you hold Samsung as well?
We do, yeah, but much smaller holding.
Okay. Um, and obviously they're quite good dividend payers. What's the sort of thinking then? I think you did allude to this, but why hold the American one rather than the Asian ones?
Um, so we've got, I mean, we've got about 12 or 13 stocks in the semi space, and we've just, it's the old adage of owning the picks and the shovels rather than the people sort of mining the stuff. And definitely I see huge demand for these products, and therefore the manufacturers of them should be a lot more safer, but they often these sales are very lumpy. So things like AMSL we do own, but a much smaller holding. We cut it back early in the year, and you can see very lumpy sales there, and you'll see that with some of the others, I think. So whereas Taiwan Semi, I think, is just very consistent. Samsung is a bit more about memory, which again has been, I think, a little bit overbuilt, and there's oversupply coming out of China and some other areas. So again, that's showing you again, reminder that it's cyclical. These things do make good money in the ups, and it's a bit more tougher, and the pricing gets harder. And so just really trying to find the good cash flow, good growth, but not overpaying. And particularly, I've always liked businesses that return a bit of capital. That the dividend shows discipline, not just to keep overbuilding. And I think discipline and overbuilding is again where semis tend to go wrong. We probably undoubtedly will see it in the next 3 years when certainly governments all around the world want semiconductor manufacturing onshore. I can see why. It's very understandable why they'd want it, but it will be the industry will overbuild without a shadow of doubt again. Probably 3 or 4 years out, that isn't it? But you'll have an oversupply situation again, and pricing, is very dynamic in those times. So, I think we just got to be a bit cautious into that. But some of these names, KLA, very interesting. They make a lot of the testing equipment. As these chips get smaller and smaller, and you go to, the current cutting edge is about 2 nanometers. That it's a very small space on a wafer, and so the testing equipment, the failure rate can go up very dramatically. And KLA provides all that equipment to make sure you're producing, quality chips, and your efficiency and your the load effectively is better. So again, that's the sort of company which should, is towards the end of putting in these new fabs, but they should see a lot of order flow over the next 2 years. So I think trying to capture some of those, I think, is the opportunity.
Great, thank you. In healthcare, so you've got United Healthcare in the top 10 there, and actually this question was saying, I think I did look at this the other day. So it's gone up since the election, but a lot of the other healthcare stocks have gone down. What's your kind of view on what's going to happen with health in the States, and how that company in particular is going to fare through this?
So I think, well, we've obviously seen, Kennedy as promoted as health secretary. I have a feeling that he won't get through. That it won't end up as that person. We'll have to see. So that's an important change. But either way, I think healthcare, it's aging population, without a doubt, and new products coming through, particularly these obesity drugs, which I think everything you read about them, they're very few downsides. So these and a lot of health upsides of putting more and more people on these drugs. The negative seems to be, oh well, when you come off them, you put weight back on. Well, you've obviously clearly got to change your lifestyle, but it allows you to get to that point to make those decisions. So I'm hugely positive on these drugs, and they have huge healthcare benefits of more healthier population the other side as well. So I think those are all good things. But for United Healthcare, it's effectively a provider, healthcare provider, and I think the positive there is probably going to be better, lower regulation, a lot less inefficiencies and red tape. And I don't see this time Trump dismantling a lot of the US Medicare and processes there. I think he's got other things to deal with. He's been talking about lots of other things and not healthcare in quite that way. So I think I see more deregulation should help United Healthcare. They're taking market share, so they're a pretty dominant provider, and it should be returning to the other aspect is wage growth in the healthcare sector has moderated quite a bit. So a lot of practitioners and nurses, quite understandably took a bit of time out post-COVID. And so there was quite a staffing issue 2 years ago. That's corrected quite materially, and therefore wage growth is more moderate as well, which again is helping them manage margins. So, I think it's not a stock's going to double, but can it produce sort of 15% growth per annum quite easily, I think, really, and off valuation that's not too extreme there. So if we can get 10% dividend growth, 15% earnings growth, I think it's one to lock away here.
Great, thank you. Just going down the list, Alphabet. Do you have a view on the potential breakup of Google?
I think it's not going to destroy the company if they have to sell off Chrome. And again, this is another area that may be interesting post Trump getting his people into position. He's going to change the I think it's the Communications Commission that sort of tends to run a lot of these anti I suppose monopolistic practices and things. So I think this is one that could change post Trump. The view of big tech overreaching itself. So we'll have to see really whether that is still early days and they'll appeal that. So I think there's a lot of good things in Alphabet. The AI story is very strong here. They again have very good models that are regarded very highly. And I think they're a winner down the road there. And it's still a very strong place. But we have cut it down a little bit. And it's another one that sort of crept down the list a little bit. You could worry a bit about search and how they could charge for that. If Meta as well, for instance, which is just behind that top 10, is another one we've bought back into and could be interesting. So I would say it's still, I'm positive. I'm expecting a bit less regulation with Trump in this area as well. So that might have a bit of a bounce on that. But the core business, there's some very strong assets in there and things they don't charge a lot for. So again, some of the mapping, some other areas of that business, maybe there's a possibility for revenue generation as well within it. So, I'm probably less keen relative to, say Amazon and Meta's coming quite nicely behind that one.
And then lastly on that list, McDonald's. What's the sort of view on consumer staples type holdings?
I think they're very specific. So we've seen, things like certainly the alcohol space, real hangover, as it were, from COVID, in spirits. So Diageo, very poor, destocking as people sort of all those spirits they put in the cupboard in COVID have taken some time to drink through. Beer as well, so there's a worry a little bit behind all this. Is it early signs of sort of GLPs and healthier eating having an impact in there? We're very light on a number of areas within there, or is it just destocking, or is there a wider trend within there? So we're probably much lighter on these consumer items than we've been before. McDonald's, though, is one we bought back on an element of sort of market share gains. So they lost their way a bit with pricing, very much came back hard at, offering a $5 meal in the US, and they've been taking very strong market share. And what that's done as well is improved footfall. And as people come into the stores, they're tending to spend a bit more as well on top of those better value meals. And again, we also had a slight scare of what was it recently in terms of, I'm trying to think what it was in the quarter pounders, wasn't it? And that seems to have sort of lifted. I think it was the onions or something provided a bit of a health scare. So I think that's improving there. So I just think this is a net winner. It's not a space we own a lot of restaurants. But I think McDonald's is a relative market share gainer, and then that really fires the bottom line quite nicely. And I think just seems to be getting its act together a little bit quicker than some of the other spaces. But I think you want to be a bit cautious of the consumer. Wage growth is moderating now, and it's coming back towards inflation. So unless prices, in the next probably phases that prices need to get cut a little bit, I think, by a lot of these providers, which they'll be trying to resist. But that's the way to get your volumes up and see efficiencies come through, margins improving.
As the dividends grow in Japan, could you see the percentage that you have in the portfolio there expanding too?
Probably not a lot more. I mean, Japan's only about 6% of my benchmark, and we're at 14, 13. So we've been, top slicing a bit as it's kept doing reasonably well, and that helped us a little bit. Last year, I think the big gap in the portfolio is a bit of Asia. If you look at long-term trends the next 10, 20 years, that region is forecast to, it's a younger population. It's forecast to grow quicker, hasn't got the demographic issues, and you should see, the expanding portion of the world's GDP in that region growing quicker than other markets. And so how do we get into that growth? Now, we've cut back China very dramatically. It used to be a biggish area for us. So we used to be 15, 20% in Asia. It's now just over double digits. So that's probably the one we want to, if we're seeing some better, returns in there and better government help and support in China, that's probably going to be a bit more than more Japan. I think we're maxed out in Japan. It continues to work well. It'll do well for the bottom line, but I think we've got as much as I need.
Fair enough. Now, where's the dividends? Back. Oh,
I don't think I had a specific dividend slide.
Anyway, so you've said you've grown the dividend every year for years and years and years now. How important is it to generate the income to cover that? And I think you've got fairly chunky revenue reserves. How do you decide where the dividend should be, or how does the board decide where the dividend should be?
So yes, if your cause remember, so one of the great joys of investment trusts is in the good years, we can save a bit of the income back, and it's called the revenue reserve, and it's still in the NAV, so it's not hidden. It's part of your net asset value, but it allows us to pay out these reserves in either tougher years, so certainly, let's say 2021, I want to say, which was the first year of full COVID, when I'm sure you remember, a lot of companies didn't pay a dividend, were sort of worried about the future, and then dividends came back, and also in recessions you see dividends get cut, and so we can put into reserves, and we've got about probably about a year, nearly 2 years worth of year and a half's worth of revenue reserves. And I see that as particularly allowing us these days more about being, hopefully a bit more aggressive probably in our asset allocation than we historically used to be. So I can, if you look at markets like the US, like Japan, the US is now 1.8%, yielding market. 1.2. It's actually come back a long way with the growth of those Mag 7 names. So the US market yields just over 1. So if the more you put into America, the more that hits your sort of immediate income. But we've got the reserves, and then down the road we can also pay out capital if we need to. So I think people need to get a little bit less het up about where's the revenue coming from. I think again, off a yield of 2.4, we're not the highest. It's not a huge demand. If I had a little bit more in the US, we can pay out reserves initially and then a little bit of capital. So I think these days it's a bit looser than it used to be. But I still like to think companies are on the road to a dividend, and that we'll see some return coming from them. But it's also a good reminder that stocks offer very low yields and very high valuations. You want to be a little bit cautious, about where you see the returns, the capital returns. You run the risk that they're just overpriced and the market catches up with them.
Do you have emerging markets exposure in there, or are they all developed markets?
Again, how do you define that? We've got a stock in Vietnam. We've got a stock, China to some extent is that developed or emerging? So we've got some Chinese names there as well. So I just cut the emerging markets out. We've got some names there in most of the European regions. There's less. We don't own anything in Latin America at the moment, and there's not we don't have a stock in Africa either. So we used to have a more dedicated sleeve to them. It was just very volatile, increasingly volatile, and increasingly driven by a lot of politics and currency issues. And so, when I was looking at, how are we adding value picking stocks, which I think is what we're being paid for that. That's why we're charging a bit more than a passive. I don't think we were getting a lot of value, and we were getting more issues coming out of macro and politics. And so we sold a lot of those names in those markets. And so I would say we're in, developing and developed markets. So that includes places like Vietnam, but we're not in those classic frontier and emerging markets. I think those are for other trusts, really.
Fair enough. Thank you. Last question then for me. I think have you got a holding in the trust? Does the rest of the team have holding in the trust?
Yes, and yes. I've got a very substantial holding in the trust, and it's in the annual accounts. So it's my largest, holding of mine and my family's. So yes, I'm very much skin in the game in that sense.
Great. Thank you very much indeed. I think our audience always likes that. So thank you very much for your time today. That's really helpful. And we will follow with interest and get you back on again in a year or so. But thanks for answering our questions today.
Cheers.
Next week we'll be back and we've got a panel again. So Investing for Income is the title, and we've got 3 panelists lined up. There'll be more information about this coming to you quite soon, I think. The week after, we've got Henderson High Income, David Smith on, one of Alex's colleagues. And then we're talking to Craig Baker from Alliance Whittam again. I know it's relatively quick after the last time, but obviously with the merger done and a couple of new managers in there, we thought it was quite a good idea just to catch up with where things are. Then we'll have a bit of a break for Christmas, and then I'll be back in the new year with Andrew talking about what happened over the course of 2024. So thank you very much for tuning in today. Have a good weekend, and we will see you next Friday.